Marcus and his wife made $89,000 last year. They paid the federal government $13,100 of it. Another household made the same $89,000. They paid zero. Not less, not a smaller amount, zero. Same country, same year, same $89,000. I'm Cole, and what I just told you is not a conspiracy theory. It is not a loophole. It is the tax code working exactly as written. By the end of this video, you will know which household you are in right now and the specific moves that start shifting you toward the cheaper one. Let's get into it. If you want to keep seeing the math behind systems nobody taught you in school, subscribe to Cold Capital right now. No sponsored funds, no products being sold, just the numbers. Marcus is 34, Memphis, Tennessee. He runs logistics at a warehouse, $58,000 a year. His wife is a medical receptionist, $31,000 a year. 2 kids, they own their home. Marcus contributes 4% to his 401k just to get the employer match. No credit card debt, no reckless spending. They are doing everything the financial system told them to do. And here is what the system charges them for that. After the standard deduction, $32,200 for a married couple in 2026, their taxable income is $56,800. Federal income tax on that is $6,320. But that is not the full bill. Before that paycheck ever reaches Marcus, before he sees a single dollar, the government takes another cut. It is called FICA, Social Security, and Medicare. 7.65% of every dollar they earn. Not after deductions, off the gross. Every paycheck, every month, every year. On $89,000 in wages, that is $6,809. Now, add it all together. $6,320 plus $6,809. $13,129 gone. Before rent, before groceries, before a single decision Marcus gets to make. Now meet the other household. They also made $89,000 last year, but their income came from investments, stocks they own, dividends from a portfolio, assets that grew while they slept, not while they worked, while they slept. In 2026, a married couple burning up to $96,700 in long-term investment gains pays 0% in federal capital gains tax. 0%. That is the actual IRS rate, not a workaround, the published rate. And investment income pays 0 FICA, not a reduced amount, 0. So Marcus goes to work 5 days a week and pays $13,129 to the federal government. The investment household does not go to work and pays nothing. Same $89,000, $13,129 gap. Here's the thing most people do at this point. They say, that is nice for rich people. That is not for someone like me. And I understand that feeling completely. But I need you to hear this carefully. The income threshold for the 0% capital gains rate in 2026 for a married couple is $96,700. Marcus's household earns $89,000. If that $89,000 came from investments instead of wages, he would qualify for the 0% rate. This is not a wealthy person's tool. It is a tool for anyone whose income comes from the right source. The source is the variable, not the amount. Now let me show you exactly why the code is built this way, because the answer changes how you see everything. Congress designed the tax code to encourage capital investment, build companies, fund growth, create jobs, grow the economy. Their logic, if we tax investment income less, more people will invest. That logic is real. It is in the legislative record. But here is what was never announced to workers like Marcus. That policy decision creates 2 completely different price structures for the exact same dollar of income, depending entirely on where it came from. Economists call it the 2-income system. Track 1 is labor income, wages, salary, anything you earned with your time. Highest combined federal burden available. Track 2 is capital income, dividends, long-term gains, income from things you own. lowest combined federal burden available. Marcus has never been told these two tracks exist. He was told to work hard, save what he can, get the 401k match, pay his taxes, and be responsible. All of that is good advice. None of it tells him that the track he is on charges 14.8% of his income to the federal government, while the other track charges 0% on the same amount. And in July 2025, Congress signed the One Big Beautiful Bill Act. It made these preferential rates permanent. This is not changing. The gap is locked in. Before we go into what Marcus actually does about this, let me destroy 3 things you may be thinking right now. Fast. Myth 1. Rich people pay more in taxes. They pay more in dollar amounts sometimes. They pay lower rates on most of their income. The nurse earning $75,000 in wages pays her marginal income tax rate plus 7.65% FICA on every dollar. The investor earning $75,000 in qualified dividends pays 0% capital gains and 0 FICA. The nurse's effective combined rate is higher. Dollar amount and rate are 2 different conversations. Do not let anyone mix them. Myth 2. I need to be rich before investing makes a difference. Marcus's first $500 in a Roth IRA earns returns taxed at exactly the same rate as a billionaire's returns inside a Roth. 0. The account does not care about the balance. The tax advantage is identical on $1. Myth 3. My 401k is enough. A 401k is a good start, but a traditional 401k defers taxes. It does not eliminate them. You pay income tax on every withdrawal in retirement. A Roth IRA grows tax-free. You pay nothing on the growth. These are not the same vehicle. Knowing the difference is worth tens of thousands of dollars over time. Now, 3 specific moves, real numbers, starting this week. Move 1. Open a Roth IRA. Marcus's household income is $89,000. The 2026 income limit to contribute fully to a Roth as a married couple is $236,000. He qualifies easily. Contribution limit, $7,500 per person per year. That is $625 a month. Growth inside a Roth is tax-free. Withdrawals in retirement are tax-free. The difference between $7,500 per year in a Roth versus the same $7,500 in a taxable account over 20 years at 10% annual return. $487,000 in the Roth, $406,000 in the taxable account. That $81,000 gap comes entirely from structure, not stock picking, not market timing, structure. Move 2. Buy one fund, FCROX at Fidelity, 0 expense ratio. VTI at Vanguard or Schwab, 0.03%. These funds own the entire U.S. stock market. They generate almost no annual taxable distributions. Marcus controls when he pays capital gains, when he sells, not before. That is not a small thing. That is the structural feature that keeps him on the cheaper side of the tax schedule for as long as he holds. Move 3. Calculate your Track 1 cost right now. Pull your last pay stub, find the Social Security line, find the Medicare line, add them to your federal income tax withheld. Divide the total by your gross income. That percentage, that real number, is what Track 1 charges you every year. Write it down, because every dollar that eventually moves toward investment income faces a different schedule. The migration does not happen overnight, but it starts with knowing the exact price you are currently paying. There is a vending machine. 2 slots, same product inside both. One slot is labeled salary, full price, plus the service fee. The other slot is labeled investment income, half the price. The machine works exactly as designed. The cheaper slot is not hidden. Nobody made it illegal to use. They just never put a sign on it. And nobody in the buildings where most of us learned about money ever pointed at it. There is no prize for paying the higher rate. There is no certificate waiting for the loyal wage earner who never found out there was a second slot. The tax code is not unfair by accident. It was written to reward a specific behavior. The moment you understand which behavior, you understand exactly what to do next.